I'm very, very focused on crypto again right here. I'm very focused on bonds, very focused on crypto. And it feels that the crypto markets want to start pricing this.
Yeah.
How are you thinking through that? Jurrien, fantastic to see you, my friend.
Good to see you too, Raoul.
So look, this is interesting because we're going to skew this discussion more about crypto than macro, but you and I are both macro and crypto people. So, it's always why I love speaking to you. So I think firstly, I think a lot of people know who you are, but just give a little background who you are, and then we'll start digging into what your macro framework is right now, because I think that's important in the contextualization of our conversations.
Of course, sure. So I do macro here at Fidelity. I've been here for 27 years. I've been in the industry for close to 4 decades. Sounds longer than it feels, but like you, I'm from the islands. I grew up, born and raised in Aruba of Dutch parents. Found my way to the U.S. and I've been here my whole adult life. And kind of went down the rabbit hole on Bitcoin a couple of years ago, but most of my day job is just dealing with the macro. Where are we in the cycle? How do we connect all the dots on what the Fed is doing and geopolitics and the market cycle and all of that stuff. And in terms of my framework right now, it literally just all comes down to earnings here because market's gone down 25% to the recent lows. That can all be perfectly explained by valuation and what valuations should have done when the liquidity tide goes from in to out, which of course it has done in a very rapid way. And you can explain that all almost to the decimal point in terms of what that means for the valuation in the stock market here. But a valuation reset and a full recession bear are 2 different things. And you know this because you've been actually very prescient in calling for this for the last few months. But a typical bear market's 33% over 19 months. A typical recession bear is about 35%. A typical non-recession bear, which is by definition only a valuation reset, is 22%. So we've done 25. We've done it over 6 months. And if earnings are not the next shoe to drop, then we're good to go. There may not be a catalyst for a monster rally, because then for that to happen, you would need PEs to go up. But if earnings end up being the dog that does not bite, then I think the market is on pretty solid footing here. But if we're about to have an earnings contraction, which of course would be part of a recession scenario, then we're not done yet. So that's kind of the main thesis here.
Have you broken down the sectors somewhat, not at super granular level, but once you see kind of energy and some of the others, their earnings obviously are holding up because this is a good environment for them, and technology seems to have maybe priced in a recession more so. I mean, I look at a very simple perspective is the year-on-year rate of change of, let's say, the NASDAQ and the S&P. You can see in the NASDAQ, it's pretty much priced in ISM at 42. So it's kind of fully there already, or very close. Yeah. What are your thoughts?
Yeah, no, I agree. And it's interesting, energy is such a small sector. It's not as small as it used to be, but it's a lot smaller than it was in the 80s, for instance. So when you look at the consensus earnings estimates for the market, they're like eerily quiet. They're at 4% growth for the second quarter, which we're just starting to report now. But you strip out that little tiny energy sector and you're down to minus 4%. So earnings are already starting to contract. But the big tech or the big growers, the long duration stocks, were obviously caught in the crosshairs of this rate reset. I mean, 10-year yields like a 1% a year ago or something like that, and it's 3% today. Real rates went from -2 to +1 in pretty rapid order. The long duration stocks, which by definition means discounting a long stream of earnings, those are very sensitive to changes in the discount rate or the cost of capital. And so they fell hard, as you would expect them to when interest rates rise rapidly. But now interest rates, I think, have peaked for the cycle. The terminal rate has gone from 4% to about 3.5%, and the relative performance of the large growers to the S&P or to small value, if you want to make an extreme pair trade out of it, is very highly correlated to changes in interest rates. And so, the leaders during this downturn have, of course, been the defensive names, utilities, consumer staples, but the staples are starting to get hit by the strong dollar because they're very sensitive to currency moves. And utilities have gotten kind of expensive. So I think the leadership actually is returning to the big growers here. And as you said, they've already discounted a lot of bad news.
Yeah, because I've actually created a basket of further out than NASDAQ, so the real kind of growth end of the market, did a whole basket of stuff. And I mean, that's pricing the ISM at 38. Yeah. So, I mean, that's a full and deep, negative 2%, 2.5% recession. So, I totally agree. Before I move on to bonds, which I want to get to, because they are the most mispriced versus where we are in the business cycle right now. When you go around Fidelity and to speak to the analysts and say, why haven't you taken down your forecasts? What do they say? Because I always find it amusing because the macro guys are always looking at the forecast and the bottoms up guys are doing different stuff. And sometimes we see different pictures and one time one side is right, the other side is right. What do they say when you talk to them?
Well, our analysts have been, correctly positioned in terms of lowered expectations. And, I don't want to say that I speak for my colleagues in saying this, but that there is a sense that sometimes the companies who, of course, guide the analysts, the sell side analysts, we're, of course, the buy side, but the companies who guide the analysts who then lower their numbers, that hasn't really happened yet, right? The numbers are kind of still up there, still expecting 10% earnings growth for this year. Now, part of that is energy, again, as we mentioned earlier, but there's a sense that sometimes the companies themselves are the last to know that their earnings are not going to hold. And so maybe part of this is just a game where everyone is just pretending that the numbers are fine until they're not, and then they get guided lower. But when it started with those big misses of the big retailers, last quarter, certainly the market has been put on notice that there's a change going on. And obviously we have a massive inflation problem, at least right now. The forward-looking numbers are coming way down, of course, but the backward-looking CPI is up 9%. And it becomes a question of how much companies can push those prices onto consumers at this point in the game.
What is your hunch here? Do you think that we do take down earnings? Now, they're coming down already, as you said, it's kind of being hidden by the energy sector. Do we take down earnings further so we get to the 33, 35%, and we're kind of there for price? And again, I use the year-on-year rate of change. That would bring us down to, versus the ISM, would bring us down to the low 40s, maybe just below that. Is that the most likely outcome to you, i.e. we've got another leg lower? Or do you feel like, maybe we can... It seems difficult to avoid a recession, but I don't know. What do you think? It's tricky. It feels tricky here, right?
Yeah, it's a
because
very.
I share your longer term view, but it's this little kind of 3-month window that's difficult.
Yeah, it's a very tricky question because you look at the headline economic data. Obviously, the ISM has rolled over, but that doesn't, you need to get into the high 40s, as you know, on the PMI to be consistent with negative GDP growth. And of course, we do have negative GDP growth, but it's not really a consumer-led negative GDP growth, right? It's inventories, exports, it's stuff like that. And then you look at the payroll number, we're still printing a few 100,000 a month. Hard to, and I look at the TSA data, 2.4 million passengers a day. Consumers don't seem to have gotten the memo that a recession is imminent. But again, maybe they're the last to know, right? Because they're not going to stop spending until the jobs start disappearing. And we already see, news that companies are not hiring as much, but they're not really laying off in droves either. So I do think it's premature to say that certainly that we're in a recession. I think clearly I shouldn't say clearly, but my guess is that we're not in a recession other than the technical definition of how GDP is constructed. But, the consumer is 70% of the economy. So if the consumer is employed spending still has some savings left from the pandemic. It's hard to see, it's hard for me to connect the dots to an imminent recession, or certainly one that's already happening. But clearly the cycle is slowing. There's no question about that. But the cycle always goes through a phase where it's slowing. Clearly earnings growth is slowing. It was 50% growth rate 6 months ago. It's about 15% now, probably on its way to 5 or maybe even less. When I look at the internal numbers, so when I look through the consensus estimates and I look at the breadth of the number of S&P 500 companies that are seeing their earnings estimate go up versus down, we've gone from 90% a year ago to now 40%. But even that 40% is not necessarily a recession level. You just, you can lower company, you can lower earnings estimates, but still be positive on a year-over-year basis, right? If that makes sense. So I'm not at all ready to ring the bell on a recession, but clearly we're in an advanced late cycle phase of the market and the economic cycle. And clearly things are slowing. Just consumer disposable income is being eroded by inflation. Companies are going to have a tougher time passing on their higher input costs. It's interesting. I'm in full-on plan. I run a theme camp at Burning Man, not to completely change topics here, but Burning Man's in about 4 or 5 weeks from now. And as the TCO, as the theme camp organizer, I'm in heavy planning mode. And the economy remains very resource constrained, trying to find people to help, move stuff in Reno, securing propane, like stuff like that. So there are still a lot of problems in the economy in terms of bottlenecks and resource constraints. So I think, whenever the next recession comes, and eventually it will, of course, maybe some of that will get resolved, but we're not there. Like, to me, it still feels like a pretty tight economy.
The one thing that does stand out, well, there's a couple of things that stand out. First one is inventories. They're massive. And obviously there's a logical reason why we got to such large inventories. I mean, and again, inventory liquidation is a GDP number as opposed to an economy number. Actually, we all benefit because people tend to mark down prices. We get some good bargains and things clear. How are you thinking about the inventory cycle?
Yeah, I think, we were guessing, or we were suspecting during the real supply chain bottleneck days, and they're still there, but they're not as bad, that companies were maybe double ordering, triple ordering, just to make sure they had stuff to sell. And I think in retrospect, it's pretty clear that they did. And then consumers started to change their consumption behavior, right? So when we saw the earnings numbers from Target and those companies, last quarter, you can tell that people are buying fewer air conditionings or sofas. So some things are easier to get, but other things are still very, very hard to get. Anything, of course, energy related. Try to find, try to rent a truck. Things like that are still very resource constrained. So the inventory overhang, which is pretty serious at this point, is not across the board. Again, you try to fly somewhere, the airfares are off the charts, the hotel charges are off the charts. So we're not seeing an evenly kind of spread out post-inflation scenario yet. You have to kind of pick and choose.
The other thing that's striking of this is how fast consumer sentiment, small business sentiment, has collapsed. I mean, it's at recession levels, yet spending is not at recession levels. Yeah. There's a couple of interesting things that make me think that, regardless, I mean, my view is probably slightly more bearish on the economy than you right now, but either way, it feels like it'll be over quick. Because if I look at investor sentiment, they're really underinvested right now. How are you thinking through that dynamic in the markets?
Yes. So certainly on the investment flows, it's interesting that when you look at investor flows, mutual funds, ETFs, they haven't really done anything during a 25% bear market. I mean, 25% is a significant decline, and we haven't seen that capitulation in flows that you would normally see at some point. And I think part of the explanation for that is that we never really got the inflows in the first place, right? So, I mean, obviously we had the whole meme stock thing happening during the pandemic and in the aftermath, but that already peaked a year and a half ago, and that wouldn't be represented by like ETF flows. Those would be individual kind of stock things. But when you look at the flows since the financial crisis, which I think was the game-changing moment where investors really started to distrust equities as an asset class, equities have taken in 500 billion or so cumulative over that entire, what is it now, 13-year period, 14-year period. And that's 500 billion out of a market cap of 40 trillion. But then you look at bonds, they took in about 3 or 4 trillion out of a market cap of maybe 20 trillion. So if you're looking at potential dislocation of investor flows moving in and then moving out, it's the bond market where we should be looking, not the equity market. And in terms of your question on just consumer confidence, obviously the confidence numbers are low, but I think a lot of that is actually tied to the inflation. I mean, inflation is a massive problem, right? I mean, it's 9%. Many people have never had to deal with that. You have to go back 50 years, and not everyone was around 50 years, 50 years ago. But if you look at the consumer surveys, the confidence numbers, and you tie them to, for instance, employment, the numbers are much higher, right? Because people are employed, the labor market is super tight. There's some pricing power on the wage front. So I think a lot of the consumer confidence survey data can be tied to just the inflation problem, which of course is massive right now.
I think we both share the view that the tightening cycle is probably done in terms of what the bond market's going to price in. I look at the year-on-year rate of change of bond yields, and they're pricing ISM at 63. This happened in 2008, 2001, and 1994 as well. It feels like yields have, to me, a reasonable amount to fall here. How are you thinking through bonds?
Yeah, I agree that 3.5 on the 10-year, which was the high print shortly after not this most recent CPI report, but the previous one, where it came in at 8.6. The consensus had been, and I'm guilty of that as well, that, at least on a rate of change basis, because of base effects, that inflation, maybe it would stay stubbornly high, but it would at least start to roll over maybe 3, 4, 5 months ago. And of course, that was then the whole Russia-Ukraine thing happened, of course. And so that rollover didn't happen. So 2 months ago, we printed 8.6. That ratcheted up the expectations for the Fed cycle, right? The terminal rate, the expected endpoint for the cycle went from the low 3s to 4%. That was the peak for the cycle, at least until now. I think it probably is the peak, in totality, but that was the highest point at that point. That was 3.5% on the 10-year. I have a little bond model that just does a regression of the long-term growth rate in nominal GDP and the shape of the forward curve for the Fed. And 3.5 is pretty much the upper bound. And since then, that terminal rate's come down. It's around 3.5 right now, despite the fact that the CPI printed an even higher rate of change for this last month. So my sense is that 3.5%. I think when I look at the tips market and what the tips market is saying, and the tips market could be wrong, right? 30% of tips are owned by the Fed, so maybe the price signal is not there anymore. But the 5-year tips break even has fallen 110 basis points in 3 months. The 5-year forward, which is a esoteric concept that only the Fed could come up with, but the 5-year inflation rate expected 5 years from now, that's down to 205, right? So the bond market is like, no problem, we're going to go back to 2%. And if that's true, I mean, obviously that would be amazing. But if that's true, then the Fed will not have to push the cycle into overdrive, right? So historically, when you look at R star, the natural rate, which is a real rate, the Fed during an easing cycle will go 200 to 300 basis points below that, and during a tightening cycle will go to 200 to 300 basis points above it. So you got about a 5% full cycle in terms of the Fed funds rate, and 3.5 would be about 1% above neutral, neutral being around 2.5% nominal or so when you look at the dot plot or you look at the R star data. And so it's restrictive, but it's not so restrictive that it's like, oh my God, the economy is just going to completely fall off a cliff. I mean, maybe it will anyway, but maybe 100 basis points over neutral is the new 300 over, just because the economy is so levered to low rates.
I look at 5-year real rates, put a little log regression channel on my Bloomberg, and it's been coming down for 2 decades because of the baby boomers and debt, as we both know. And it looks like the trend rate, the average trend rate, is -1.
Yeah,
which is like where fair value of real rates is now.
If you look at the real Fed funds rate, it's a series of lower highs and lower lows, right? And of course, the lower low after the pandemic was off the charts low, right? If you start converting QE into a rate equivalent, which I do, I assume that every 500 billion is worth 75 basis points. That's from an old Taylor rule model from the San Francisco Fed during the Janet Yellen days when she was the chair of the San Francisco Fed. On that basis, the global GDP-weighted short rate right now is adjusted for QE is -9%. I mean, it's incredibly, and of course the US is leading the charge into trying to normalize that, which of course is why the dollar is so strong, because the dollar just reflects the policy divergence between the US, which is tightening rapidly, right? The TIPS real yield has gone from -2 to +1 in like 6 months. I mean, that is a very now +1 is still relatively okay, historically speaking, but that's a 300 basis point delta happening very, very quickly. And for an economy and a market that is so sensitive to interest rates and real rates, that's a lot to handle there.
Yeah, I mean, I put together a model of the rise in the year-on-year rate of change of interest rates, commodity prices, and the dollar as a financial conditions index that's a bit broader. And this has been, because of rate of change matters, it's been one of the larger tightenings in history, and the fastest. So, it should slow economic activity, and that's what leads me to believe that yields come lower.
And you have this great chart that you showed me the last time we were on with, I forget when that was. I'm just curious how that chart, obviously that was very, 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 very prescient. Just curious where the data points are at this point.
So that actually got down to an ISM of 35, 36, and it's starting to turn up because rates are starting to come down and commodities have rolled over. It forward-looking suggests that we've got a sharp air pocket in the economy out to 9 months. But much to our conversation, the Nasdaq's pretty close to having priced it in. The S&P might have a bit further to go. It's somewhere within these bands that you and I were talking about. The low being whether that was the low or whether we got another push to price this in fully, because the year-on-year comps are actually quite difficult because all the markets were screaming higher from this point on last year. High yield spreads, small caps, cyclicals, defensives, they're all kind of roughly where the ISM is now, slightly leading it. And it's the US Treasury 10-year yields that's way off.
Yeah. I think we need to get to the end of the Fed path. I mean, the market's still pricing in about 200 basis points further of rate hikes just this year, right? And a lot of airtime, I think, is being spent on speculating whether the Fed goes 75 or 100 or 50. Like, I don't really care. It's like, where are you going to turn up? Where are you going to end up, right? Is it 3, 3.5, 4? I think that's the most important part. And what's interesting is that as expectations get ratcheted up towards a tighter Fed, on the other side of that forward curve, expectations are growing that it will be very quickly undone by rate cuts, right? So at this point, the forward curve, the SOFR curve, has a kink in it. It goes to 3.5, and then it goes to 2.5 after that. So the market believes that if the Fed is forced to push this thing, it's going to break the economy and create a recession, and then going to have to come back down. So hopefully the Fed ends up not having to go as far because the forward-looking inflation data are starting to improve, if we can believe the bond market at least. So we'll see, but we're going to find out fairly soon. But I agree that anything north of 3, in my personal opinion, on long rates has some value, and certainly the long demographic wave and all that stuff hasn't gone away at all, right? So, but I think what will be interesting over the next, let's say, 6 to 12 months is, let's say inflation comes down here. I think even the biggest inflation bears will say that the rate of change should start to improve. I mean, oil's down, copper's down, used car prices are down, everything is down, so it should start to improve. But what will it improve to, right? So if 6 months from now we're in a recession, again, not my base case, but let's say it happens, or 12 months from now, and inflation has gone, the CPI has gone from 9, but is only going down to 4 instead of down to 2. What does that do to Fed policy and this dual mandate balancing act that they have? Will that remove the Fed put because they just won't have the leverage to lower rates as far as they otherwise would because inflation is above their target? I think, to me, that's going to be the next big conversation that we're going to have.
Yeah, and people are having that debate. I've taken the other side of it for now, and again, we're all probability guys, and we adjust our frameworks as we go. I actually think, and you and I have talked about this in the past, that we might actually be close to 1947 to 1949, where inflation went from plus 20 to negative 6. Yeah. I actually think we go negative, but that's not the game to play right now. The game to play is looking for the turn of the cycle and the Fed cycle and the interest rate cycle, I think.
And you mentioned the 46, the 1940s. You and I have both used as an analog, and that's been a very good one to use during this whole pandemic period. First in terms of like 42, 43, all of that fiscal monetary firepower being unleashed and what that did to the market. And then kind of now on the hangover side, where you had the end of the war, hopefully the end of COVID, but with this inflation hangover, S&P went down 26%, and then it sat there for 3 years until 1949. And there was no earnings recession because typically when inflation is high, nominal earnings, which of course is what most people will look at, are okay. Earnings were okay in the 70s. But the valuation side is where the haircuts are. And the PE ratio from 46 to 49 went, I think, from 22 to 5. Now, I'm not suggesting we go to 5 here, but that is an enormous PE haircut, and that's why the market didn't recover right away, even though earnings were okay. It's because just nobody wanted to pay for those earnings anymore, and so that it's a good example of a purely valuation-driven bear market in a period of high inflation.
So people are probably wondering why the hell we're talking about all this macro and why it matters to crypto. And the point being is we both think we're in the zone where things are going to change. Perceptions of inflation, perceptions of interest rates, and perceptions of future growth expectations and how you discount it may well change. So talk us through how this fits into crypto, and then we'll dig into some of the other things you've been doing in crypto, because I think you do some of the best analysis out there, bar none, and I think it's super interesting. But just give us why macro matters to crypto so people can frame that.
Well, I think macro matters. So I focus mostly on Bitcoin, a little bit of Ethereum, but those two are really the only ones I've done extensive work on. And Ethereum to me, and I think you agree with me, is a technological revolution. But it kind of goes on one side of the risk, not of the risk spectrum, but like of the 60-40 spectrum, right? Like that's a kind of a growthy venture type of asset based on changes in technology. Bitcoin has that, of course, but it's also an aspiring store of value. And I say aspiring because it hasn't quite proven itself yet, right? It's still coming of age. It's still trying to get up there alongside of gold as a store of value. And until it has proven itself, it's kind of a venture asset, right? And as we've seen over the past 6 months, Bitcoin as much as it tries to be the anti-fiat, still suffers from the whims of stuff that happens in the fiat world, including leverage and speculation. And of course, we're seeing that winter unfold before us. But the macro narrative, I think, is important in providing kind of the recognition point or the narrative for adoption, right? So we saw, of course, in 2020, I think Bitcoin bottomed at 3,000. Then we had the pandemic, we had the policy response, again, like right from the 1940s playbook, that high octane fiscal monetary policy, and Bitcoin went off to the races. And I think part of the value proposition was, okay, we're going to print ourselves into oblivion. M2 growth is just off the charts. The excess money, as we call it, the difference between money growth and GDP growth, I think went to like 35% or so, the highest probably since the 40s or the 70s. And that, I think, provides the narrative for the bystander, not the Bitcoin insider, but the bystander to say, yeah, that makes sense. And so that the person who is not going to spend 500 hours understanding Bitcoin, but who sees it as a coming of age asset class, I think the macro narrative becomes important, unless you're just buying it because the price goes up, which of course a lot of people do. But if you want something more than that, it has to fit into kind of a worldview and this notion of an extended period of extremely loose policy, negative interest rates, rampant money supply growth. Those have all been good periods for gold in the past. And if we put the store of value hat on for Bitcoin, I think that was probably part of the narrative in 2020 going into 2021. And now that the Fed has reversed so quickly from that playbook, not that this was the Fed's playbook, but certainly I thought that we were going to have a multi-year period of extremely loose policy, and that the U.S. would follow kind of in the footsteps of the 1940s Fed or the modern day Bank of Japan. And who knows, maybe we still will. It wouldn't surprise me if after this cycle we go right back there.
We have yield curve control. Yeah,
we have yield curve control. We cap bond yields just like the Fed did in the 40s. And we see what the Bank of Japan is doing, right? They're doubling and tripling down on yield curve control, and their currency is suffering as a result.
Because, Jurrien, just to go back to the point we raised earlier, let's say that rates were too tight, like monetary conditions have been very high, and we can't take positive real rates. The learning from this is, oh my God, we barely raised rates and we crashed the economy, let's say. Therefore, the next time around, they will say we can't raise rates.
Yeah.
Because if not, we're going to put you back into recession again. So we have to have yield curve control at a sensible level. It feels like that's an obvious narrative to come, right?
I agree. And I think, what happens after this particular cycle that we're in, I mean, clearly the Fed has, committed, it seems, to breaking inflation at all costs. From the rhetoric that we hear, and maybe it's just rhetoric, right? Maybe it's just jawboning, but I'll take them at their word. We already see what the yield curve is signaling. So it seems that the Fed is willing to risk a recession to slay the inflation dragon. And maybe once it does, it can reverse that policy. I think what's more interesting is not so much what happens in this cycle, where we end up. I think we're starting to get clarity on that, but what happens in the next cycle. And if it's determined that interest rates are too high for an over-levered, highly financialized economy, and we go back to a prolonged period of negative real rates, then that's going to play right into the hands of the gold bugs and as well as Bitcoin. And it's really interesting. I look at gold a lot, and when I did my deep dive on Bitcoin, I looked at it from a traditional, a TradFi 60-40 person saying, like, how would a traditional investor look at this, and I did that by looking at gold first, and because gold has 1,000+ year history as money, and then it became an asset class in the 1970s, and then I kind of replaced gold with Bitcoin to say, okay, if this, then that. But when you look at gold and its valuation, gold's valuation is driven mostly by real rates, by money growth, inflation, but mostly by real rates. And on the basis of real rates and the sharp reversal over the past 6 to 12 months, gold should be trading at 1,200 right now. And it's trading at 1713, which is down from its peak, but that's about $500 per ounce more than what the TIPS model, which is what we generally use in the business, would suggest. And that maybe there's a tell there. Maybe it's just geopolitics, maybe it's Russia, but maybe there's a tell that investors are looking past this cycle and saying, maybe real rates don't go to ridiculously negative levels like they did in the 40s, but maybe they're just going to stay negative for a really long time. And then, bonds become really uninteresting, even though at 3%, they have value here, at least from a 60-40 kind of construction point of view. But, if you're looking at negative real returns as far as the eye can see, investors are going to start changing their asset mix, and gold would be a beneficiary of that, and presumably Bitcoin will be as well. Once we can kind of get past these huge boom bust cycles, which maybe we never will, but that might be a feature rather than a bug.
So here's my hypothesis here. Both you and I spend a lot of work looking at network effects and the adoption curve, right? It's clearly a logarithmic trend that is exponential in linear terms over time as adoption drives the value of the network. And you've done huge amounts of work on that. I've done huge amounts of work on it. We both tend to agree that this is one of the larger network adoptions that we've seen. So the trend is up and to the right, even though it's volatile. So the macro the only macro thing I can see that really affects it seems to be year-on-year rate of change of M2, as you were talking about. And we've got to this negative year-on-year rate of change of M2, which is generally the bottom of the Bitcoin market and the crypto markets overall. Okay, fine. So that looks right. So what we're both trying to say, which is why the macro is so important here, is we're both saying, listen, it's unlikely that M2 is going to remain so negative. We're already seeing China increasing its M2. So even if we don't return to QE and massive rate cuts, let's assume we don't. I actually think we'll get some of that maybe later, but irrelevant. But because the chart is up and to the right, you're holding a ball underwater, a beach ball underwater. And the moment M2 stops contracting, the ball rises. Just because of is that how you, so, I'm very, very focused on crypto again right here. I'm very focused on bonds, very focused on crypto. And it feels that the crypto markets want to start pricing this. Yeah. How are you thinking through that?
Yeah,
Does that make sense?
I agree with that. I think Bitcoin and the rest of crypto just has to survive this winter of deleveraging. It's the winter of our deleveraging, and because that's an idiosyncratic thing where we all know the stories of who blew up and this and that, and clearly that whole kind of balloon is shrinking, which at the end of the day, of course, will be I think a very big opportunity, because then you can get in based on the fundamentals. Which, as you mentioned, the network adoption curve is up and to the right. We don't know the slope, but it's still up and to the right. But it's nice to be able to get in when you don't have to worry about if some person is going to get liquidated and drive another 10,000 points, down. And so it seems to me we're getting towards the end of that cycle. You're seeing headlines of hedge funds and players blowing up. And, usually when you're at the beginning of a downturn, you have a sense that people are blowing up, but you don't know who they are. And when they start making the headlines, I think it's when you're later in the cycle. So I agree that it will be nice to start looking at the fundamentals. I mean, we're all looking at the fundamentals, but to start having price respond to fundamentals without worrying about, who's over their skis and has to puke out. And then it comes down to really, to me, the most important thing is the slope of the demand curve, right? So we know about supply, stock to flow. I think the stock to flow model was very useful in the early days in explaining this parabolic curve. I think it's going to be less and less useful going forward, just because with every halving, more and more coins will have been mined. You'll be closer to the supply limit, and it's just going to have less and less of an impact. So that stairway to heaven, that stair step, stock to flow curve, I think that's not a realistic path going forward. And then we have the demand curves, and as you've done it as well. There's hundreds of S curves historically that we can draw from with various different slopes, and I think this is a good place to kind of remind ourselves and the audience that we're dealing with exponential data here, right?
I want to make sure that Nico puts that big chart up of all of the historical ones that you've got, which is a magnificent piece of work.
Thank you. But we're not dealing with a linear formula here, right? It's like if you're valuing a stock and you put in the earnings growth in the numerator of the discounted cash flow model and the cost of capital in the denominator, if your cash flows are growing at 6% versus 5%, maybe the PE you're willing to pay for that stock is 20 instead of 19. But that's a linear concept, right? For Bitcoin, one S curve, which is go up and to the right, versus a steeper S curve, which is further up and to the right, can be the difference between Bitcoin at 100,000 or Bitcoin at 1 million. Like the numbers are exponential by definition, and I think that's going to be the challenge and the opportunity for investors to get Bitcoin right in terms of the potential price appreciation, because even just comparing the internet adoption curve versus the mobile phone adoption curve, again, they're the same curve, but they have slightly different slopes, and that can make a big difference. So I'm hoping that we'll get to a point in the Bitcoin super cycle where enough sophisticated investors have these kinds of demand models, and that it builds kind of a band around them, where if it goes too far above, investors will short Bitcoin or they'll sell it. If it goes too far below, they will buy it, and that maybe the volatility will start to compress as a result of that. So hopefully, as Bitcoin matures and comes of age, we'll see that. But we haven't seen it yet, so it still needs to prove itself on that front.
When I started down this avenue, this is when I suddenly discovered the network effects that ETH has got and how fast that has been. And I'm not. And again, none of this is about philosophy of the space or anything else. I just looked at the network adoption and went, oh my God, we thought Bitcoin was big, but this was big. How are you seeing the difference in the ETH versus Bitcoin network adoption models?
Yeah, no, but you're exactly right. The ETH network is growing much, much faster than the Bitcoin network, and we all know why, right? It's more scalable, it's less decentralized, it's less scarce, of course. So we don't know exactly what the scarcity is. We know what it is right now, but I think investors will always demand a discount from the Ethereum valuation, because we won't know in some future fork what will happen, to the supply, whereas we do know what will happen to the Bitcoin supply. So you're just trading one against the other, but clearly Ethereum is a faster growing network, and per Metcalfe's law, the bigger the network gets, the more exponentially the valuation of that network becomes. And I've used the example of Apple Computer, where you can see, if you look at their annual revenues, the more iPhones and all that stuff that they sell, the valuation goes up, exponentially to that, until it gets to the point, and then when it gets to the point where the network is so powerful that it has such a large moat around it, that even if I invent a far better iPhone tomorrow, I'm never going to be able to penetrate that network because it's too powerful. And I think Ethereum and Bitcoin, have reached those thresholds. That doesn't mean there won't be other coins and other networks out there, but I think they have satisfied the kind of the test to become big enough to be believed and taken seriously, right? I mean, a couple of years ago, a lot of investors said, well, this can get regulated out of existence pretty quickly. I think we've kind of that ship has sailed, I think.
So we've talked about, okay, the macro setup. It looks like it's the right kind of zone for this, for crypto to do well. We've talked about the network adoption curves. The next thing I want to talk to you about, because I think it's fascinating, is, and again, I'm not being an ETH maximalist, but I'm fascinated about the staking. Firstly, because obviously it reduces supply. So at the margin, it should mean that it outperforms as a network, given if Bitcoin and ETH had the same amount of increased network demand, let's say they grow at 10% a year, ETH will outperform naturally because we've probably got this limited supply. But what I'm really more interested in, and I think you'll be interested in as well, is I think it's going to set a benchmark rate for yield for the Web3 industry per se. So which we can then monitor risk. We've just gone through a risk blow up because it's not easy for people to understand. You and I have grown up in markets where, oh, well, EM is priced 400 over treasuries, and we price junk bonds over treasuries, and we do. So we have this benchmark of which we can understand risk. Feels like this might be the big setup, and that's a big deal for institutions. I know you guys at Fidelity are, you've got ETH now as part of the product suite. It feels that ETH yield is going to be a big thing because you make the one asset allocation decision, which is I want to get exposure to Web3.
Yeah.
Maybe you do a 60-40, as you say, with Bitcoin and ETH. But ETH now has a yield, which makes it a lot easier, and it's going to create different pricing structures for us to think about. How are you thinking through all of this? I think it's a very big deal, probably very underestimated. People only think of it in the supply terms. I think the yield thing is huge.
Well, yes, I agree. And if we can if we can start valuing Ethereum through a cash flow model, like a DCF model, and you have the growth and you have some sort of anchor to that growth in terms of cash flows through the staking, then that can be a very big deal in bringing in kind of conventional investors and by allowing them to actually value an asset class. Because until a number of years ago, Warren Buffett would ridicule gold, saying it doesn't have a cash flow. Why should I buy it? But no one's going to argue that gold is not an asset class, right? So you can have a yield-free asset as long as it does something for you, right? And gold, of course, is money. It's a store of value. It could be a medium of exchange, not that people use it that way. And I think Bitcoin is aspiring to be money as well. I wouldn't really consider Ethereum to necessarily be money, but it's certainly an asset class. It's a very growthy asset class. And so once you can start valuing Ethereum, then you can start valuing Bitcoin perhaps easier. I mean, we have the demand curve, we have the supply curve. But if Bitcoin then becomes sort of a benchmark because it actually has a cash flow, then you can do a relative value band, for instance, of Bitcoin versus Ethereum, and that could become the standard bearer then for valuing all of crypto. So I do think that would be an important milestone.
Yeah, so let's see what happens. But there's also a lot will get built on having this benchmark yield, I think. It actually makes DeFi a lot more understandable for people. What risk you're taking, what's a 20% yield, where does it come from, versus ETH, which is in ETH terms as a local currency bond, essentially. It's risk-free as a local currency bond as long as you want to take the currency risk, because it's programmed in.
And that's, it's an interesting point about the currency risk, because that, of course, is where Bitcoin's volatility comes from, because if it's a commodity currency, you have to convert it into fiat. If the adoption curve gets advanced enough that enough people own Bitcoin or Ethereum, and it's used as a medium of exchange, then that presumably would reduce the volatility because everyone would just be inside that ecosystem and you don't have to go to the on and off ramp back into fiat, right? So that's another kind of promise, which I don't know if it will be achieved, but that's another promise for if the Bitcoin network gets large enough, volatility, at least as a payment system, should be reduced because everyone will just stay inside that system.
And we're seeing the nascent start of that by so much in the Web3 world being priced in ETH as exactly the internet currency. And eventually over time, as you say, it's still early in the network adoption, but if goods and services get priced in Bitcoin over time, right now, you're not incentivized to sell it because you're still in the network adoption mode. So all you want to do is hold it. The last thing you want to do is buy a coffee with it because it's Bitcoin pizza. It's a stupid thing to do. But eventually, once the network adoption is mature, and it's growing at the rate that global money supply is growing, or central bank balance sheets are growing, then it kind of works perfectly.
Yeah.
So final thing, what is your favorite chart that you put together recently? What's the one that you've gone, wow, that's amazing? Because you've always got amazing charts.
Boy, that's like
in the crypto space. What's the one you've just gone?
That's like making me pick among my children. I would say it's the valuation chart. So I have a chart that shows Bitcoin's price, which I still think most people think about Bitcoin in price terms, which is normal, right? People think of bonds in nominal yield terms, not in real yield terms. They think about the S&P or the NASDAQ as the price level, not as the PE. But the valuation is ultimately what's the most important, right? What, for the stock market, what are you willing to pay for each dollar of earnings? It's more important than what is the price of the Dow Jones Industrials, right? So a 20 PE versus a 15 versus a 25 is the most valuable metric. And for bonds, it's the real yield as opposed to the nominal. And for Bitcoin, I created a very simple kind of valuation ratio, like a PE for Bitcoin, where I just divide the price by the millions of addresses, of non-zero addresses. That may not be the perfect way to do it, but it gives you a decent benchmark to say, okay, the network is growing, so price on its own is, you have to look at it relative to what the fundamentals are, which is the network. And so the price to network ratio, which is what I call it, is back down to 2013 levels. So, if you want to make the argument that Bitcoin is cheap versus expensive, don't look at price. The price is cheap relative to its high, of course. But if you look at an actual valuation ratio, we're back to where Bitcoin was 9 years ago. And to me, that's a good aha moment in terms of at 20,000 or 22,000, that's, the network versus 9 years ago is vastly bigger than it was then. And the price, hasn't kept up with that. So to me, that's one of the things that makes me most encouraged about what lies ahead for Bitcoin.
And I think that's a phenomenally important thing for people to understand, price to network, because what you're doing is understanding this is a network adoption model.
Yeah.
So what is the price doing in context of the size of the network? I think that's very, very useful work, and it gives us yet another way of understanding these network models that we're all trying to get our heads around, because we poo-pooed them for so long with Amazon and other stuff. We didn't get our heads around it, and now we're having to think about the world in a different way. And I think it's a great breakthrough as ever. So Jurrien, listen, fantastic to have a conversation with you as ever. And I'm sure people get a lot out of this. And, I've been saying for a long time, and you've been saying for a long time, crypto is macro, macro is crypto. They're all the same thing. They're just different assets that are affected by the macro in different ways.
It's all macro all the time, even with individual asset classes. So it's always a great pleasure to be on with you, Raoul. And thank you for having me on.
Yeah, we'll talk soon, my friend.
Okay.
Hey visionaries, thank you for tuning in. For more free crypto content like this, head over to realvision.com/crypto. You'll get early access to the most brilliant minds in the space to cut through the noise, get in-depth analysis, and get you ahead of the curve with unbiased insights.